Frontier Advisory's 2015 Africa Outlook Conference brought together industry players from across the spectrum to discuss Africa's prospects for the year ahead. International Monetary Fund Senior Resident Representative in South Africa, Dr. Axel Schimmel-Fenning, discusses the impact lower oil prices have had on the global economy.
What I've tried to highlight is some of the analysis that we've done at the IMF over the last couple of weeks, in particular by our chief economist, Olivier Blanchard. So we've seen oil prices come down dramatically. They've fallen by about half, and we've done an exercise where we look at sort of, if nothing else had changed, what would that mean for growth? And for the global economy, we really see that these lower oil prices are a shot in the arm that could raise growth this year, by 0.3 to 0.7%. But this is all else equal. There have been a number of other developments that have gone on in parallel, and one is sort of that the unevenness of global growth, which we've highlighted in our World Economic Outlook in October, has become more pronounced. So the United States showing strong growth performance, whereas a number of other countries and regions are growing slower than we would have expected. Going forward, that means probably some headwinds, because the strong, fast growth in the US may be temporary, whereas the slower growth in some of the other economies may be more permanent. So you have these two currents, one a shot in the arm from oil prices, on the other hand quite a bit of headwind from this unevenness in global activity. The immediate impact for oil producers of a lower oil price, even if they keep their production volumes unchanged, is lower export revenues and lower fiscal revenues. You can, for example, look at the price that governments put in their budget, the oil price that governments put in their budget when they forecast revenue. And you see that compared to 2014, that price has come down, but it hasn't come down as far as the market price, which means that the projected oil revenues, projections were done not today, they were done last year. Those projections are higher than what it looks like the oil revenues will be today. So countries need to find ways to deal with that. If they have institutions like a sovereign wealth fund that allows them to smooth, they can draw on that. In other cases, there may have been to be some fiscal adjustment quite quickly.
MSA Group MD Keith Scott provides some analysis about the plight of the bulk commodities market.
It's no secret that the commodity cycle ended particularly low last year, and I suppose the main theme of the year was the sharp drop in bulk commodity prices. And I'm going to stay a little bit away from oil and gas at this stage, but just talking about mineral or hard rock commodities. It was a difficult year. We do feel as an industry that we probably have bottomed in terms of commodity prices, or are close to bottoming in terms of most commodity prices. Having said that, I think we're going to remain at the bottom for a fair amount of time. There's a general oversupply in the market, especially in bulk commodities, coal, iron and copper as well. A general oversupply in the market, a declining demand. A lot of exploration and development that we did during the boom times has led to increased production coming onto the market now and in the last few years. And in a way, we've authored our own bear market, which seems to be the cyclical nature of the minerals industry. So we think we're going to be bottoming out this year and remaining in the bottom for a year or two.
Scott adds that exploration activity will remain under severe pressure owing to the challenges that companies face in raising project finance. However, he believes a long-term vision is required by industry players to tackle the current challenging operating climate.
Well, overall it carries throughout the sectors. We spent in 2012 $30-odd billion globally on exploration, and we've essentially halved that number by 2014. So in 2 years' time we've halved the number of money you spent globally on exploration, including for iron ore. But remember that in 2002 we only spent $2 billion exploring globally. So we're at about 2007, 2008 numbers. We expect that to fall a little more, remain in the early teens maybe in terms of billions of dollars. Remain in the early teens for a while. It's very difficult to attract exploration capital. Principally, exploration capital is either public equity or private equity. The public equity markets are are largely closed for exploration, and especially for what is perceived as risky jurisdictions like Africa. What exploration money there is available tends to go to Canada, Australia, and the United States into environments like that, where the risk is perceived as much lower. A very important thing to understand is that the business cycle in mining, this last upturn was 10 years. That's a very long up cycle in mining. And typically what's discovered in this cycle is only mined in the following cycle or the cycle thereafter, because it takes on average 12, 15 years to bring a discovery into production. So if one wants to be putting a mine into production when commodity prices are high, you should be looking at investing and developing now.
Frontier Advisory CEO Martin Davies believes that the current commodity price cycle provides African leaders with not only challenges but also opportunities to reassess their country's long-standing reliance on minerals as well as oil and gas resources as a driver for economic growth. For Creamer Media, I'm Ilan Solomons, reporting from market research firm Frontier Advisory's 2015 Africa Outlook Conference, Sandton, Johannesburg.